Almost everybody has heard of credit cards, but very few people actually understand how they really work. To most people, they're just a shiny piece of plastic, or today, a digital number on your phone that lets you buy things instantly even if you don't have the money at the moment. You swipe, tap, or click, and suddenly the product is yours. But what's really happening behind that smooth transaction? And why has the credit card become one of the most profitable financial inventions of the modern world? On the surface, credit cards look like a simple convenience. They promise freedom, flexibility, and rewards. You can buy now and pay later. You can travel the world without carrying cash. You can earn points, miles, and cash back just by spending. For many people, they feel like a tool of empowerment. But beneath this polished image lies a much darker story. Credit cards have quietly reshaped personal finance, consumer culture, and even mental health. They've created invisible chains of debt, built trillion-dollar empires for banks, and turned ordinary spending into one of the most powerful engines of profit extraction ever designed. Before we uncover the hidden traps, we need to understand where credit cards came from, because the story of their origins reveals something crucial. They were never really invented to help consumers, they were designed to benefit banks. The earliest roots of credit cards can be traced back to the mid-20th century in the United States. In the 1950s, a businessman named Frank McNamara forgot his wallet at a restaurant in New York. Embarrassed, he came up with an idea, a small card that could allow people to pay for meals on credit. This idea became the Diners Club card, the world's first modern charge card. Customers could use it at participating restaurants, then settle their bill with Diners Club at the end of the month. Other banks quickly noticed the potential. In 1958, Bank of America launched the Bank AmeriCard, which would later evolve into Visa. Soon after, MasterCharge, now MasterCard, entered the market. Unlike Diners Club, these weren't just for restaurants. They could be used at a wide variety of stores. It was the beginning of a financial revolution. At first, credit cards were marketed as symbols of status and convenience. But banks weren't simply offering a helpful service. They were building a new system of consumer lending, one where every purchase created an opportunity to generate interest, fees, and profit. Over time, the business model shifted from just convenience to something much more aggressive. Today, credit cards are everywhere. In some countries, they're almost unavoidable. They fuel entire economies, drive global trade, and influence how people think about money itself. But the deeper you look, the more you realize, credit cards aren't neutral tools. They are carefully engineered financial products, designed with layers of psychology, technology, and economics to benefit one side far more than the other. And that's where the dark side begins. How credit cards really work, the hidden mechanics. When you use a credit card, it feels like free money. You swipe or tap, you walk out of the store with your purchase, and you don't feel the immediate loss of cash leaving your wallet. But that invisible transaction is exactly what makes credit cards so powerful and so dangerous. Here's what really happens. Every time you make a purchase, the credit card company is essentially giving you a small, instant loan. You don't own the money, you're borrowing it. At the end of the billing cycle, usually 30 days, you get a statement showing how much you owe. Now here's the trick. The statement doesn't just say, pay the full amount. It also gives you another option, the minimum payment. This is often a small fraction of the total, sometimes as low as 2 or 3% of your balance. To the average consumer, this looks like flexibility. You don't have to pay everything back right away, you can stretch it out. But in reality, this is the trapdoor. Because the moment you choose to pay less than the full amount, interest begins to pile up. And credit card interest isn't like normal interest. It's some of the highest in the financial world, commonly between 18% and 25%, and in some cases even higher. Compare that to a mortgage, it may be 6%, or a car loan at 7%. Credit card interest is in a league of its own. Let's put it in perspective. Imagine you owe $5,000 on a credit card with a 20% interest rate. If you only pay the minimum each month, it could take you more than 20 years to pay it off, and you could end up paying double or even triple the original amount.
What started as a purchase of a laptop or a vacation can silently grow into a mountain of debt that follows you for decades. But why do people fall for it? Psychology. Credit cards are designed to separate the moment of purchase from the pain of payment. With cash, you feel the loss instantly when the money leaves your hand. With a credit card, that pain is delayed, softened, and disguised. By the time the bill comes, the excitement of the purchase is long gone, but the debt remains. Even more subtly, card issuers use rewards, cash back, airline miles, points, as psychological bait. Studies have shown that people spend more when using credit cards than when using cash. Why? Because swiping plastic doesn't feel like spending real money. Add in the promise of rewards, and suddenly overspending feels like winning. But here's the hidden truth. The rewards are crumbs compared to the interest and fees banks collect. For every dollar in rewards given out, the banks make several dollars in profit from fees and interest. Behind the scenes, every transaction is part of a massive system. Merchants pay a fee to accept credit cards, often 2 to 3% of the purchase. That fee is split between the bank that issued the card network, Visa, MasterCard, etc., and payment processors. Then, if the cardholder carries a balance, the real money flows in. High interest, late fees, balance transfer fees, cash advance fees, and more. In short, what looks like a convenient tool for consumers is in fact one of the most profitable machines ever built for banks. Credit cards are not about convenience. They're about capturing as much profit as possible from human behavior, spending impulses, procrastination, and the desire for instant gratification. The system is so effective that in many countries, household credit card debt has reached record highs. Millions of people are stuck in cycles where they pay and pay, but the balance barely moves. It's not an accident. It's the design. The psychological traps. How cards manipulate behavior. At first glance, a credit card looks nothing more than a payment tool, but in reality, it's also a psychological device designed with precision to influence the way people think and behave with money. To really understand the dark side, we need to explore these traps. The first trap is the illusion of affordability. With cash, the cost of a purchase is immediate and painful. You hand over a $100 bill and watch it disappear. But with a credit card, the pain is delayed. You don't feel the financial hit in the moment. Psychologists call this decoupling. The purchase and the payment are separated in time, which makes people spend more freely. Studies consistently show that people spend 12 to 18% more when paying with a card instead of cash. The card makes expensive things feel cheaper, even though the cost is the same, or worse once interest is added. The second trap is minimum payments. By showing a low minimum due on the bill, credit card companies are nudging people to pay less. Behavioral economists have found that the simple presence of a minimum payment option drastically reduces how much people pay back each month. It creates an anchor in the mind. If the bank says I can just pay $50 this month, maybe that's fine. But what really happens is the balance lingers, interest grows, and debt chains tighten. The third trap is rewards and perks. Cashback, points, airline miles, they feel like gifts. In reality, they are bait. The average reward rate is around 1 to 2%, while the average interest rate is 18 to 20%. In other words, you might earn $1 back, but you could lose 20 in interest if you don't pay in full. Rewards programs are designed to trigger the brain's dopamine system. Every swipe feels like a small win, even when it's financially harmful.
Another subtle trap is the endless credit limit increase. Many cardholders notice that after a few months of consistent payments, their credit limit suddenly goes up. At first, it feels like a reward for good behavior, but in reality, it's a setup. By raising your limit, banks encourage you to spend more, which increases the chances of carrying the balance, and therefore paying more in interest. The bank isn't rewarding you, they're investing in your future debt. Then there's the trap of social status and identity. Premium cards with shiny metal designs and names like Platinum, Gold, or Elite are marketed as symbols of success. They don't just process payments, they sell identity. People start to associate their self-worth with the type of card they carry. It's not just about buying something, it's about feeling powerful, exclusive, or important. And that emotional attachment makes people more loyal to the card, even when it costs them financially. But perhaps the most dangerous psychological trap is the normalization of debt. In many societies today, carrying credit card debt isn't seen as unusual. It's expected. People talk casually about maxing out their card or just paying it off later. Debt becomes part of everyday life, and once debt feels normal, the urgency to escape it fades away. That's exactly what the banks want. Credit cards thrive on human weakness, impatience, optimism bias, and the tendency to underestimate long-term consequences. We tell ourselves we'll pay it off next month. We believe we can manage it. We think the rewards make it worthwhile. But slowly, quietly, the balance grows and the trap closes. What makes this so dark is that none of it is accidental. Every design choice, the layout of the statement, the flashy rewards, the low minimum payment, is the result of decades of research in behavioral economics and consumer psychology. The industry knows exactly how to exploit human tendencies, and the result is billions in profit extracted from ordinary people, one swipe at a time. The business of debt, how banks profit from your spending habits. Behind every credit card swipe, there's an entire business model at work. Banks and card networks don't just make money from interest, they profit at almost every step of the process. First, there are interest payments, which form the backbone of the credit card industry. With average APRs hovering around 18 to 24%, balances that linger can double or triple in just a few years. Interest is the hidden tax of convenience, and it's where the banks make their biggest profits. Then come the fees. Annual fees, late payment fees, foreign transaction fees, balance transfer fees, the list never ends. In 2023 alone, U.S. consumers paid over $130 billion in interest and fees combined. Every small slip, every late day, every international purchase is another stream of income for the banks. But the business doesn't stop there. Every time you use your card, merchants are charged a swipe fee, usually around 2 to 3% of the purchase. This cost often gets passed on to consumers through higher prices. So even if you never carry a balance, you're still part of the profit system. And then there are the rewards programs. They look like gifts, but in reality, they're funded by two things: the money other cardholders lose to interest and the extra costs merchants charge to cover swipe fees. In other words, rewards are not free. They're redistributed wealth, taken from those who can't pay in full and given to those who can. What makes this machine so powerful is that it's self-reinforcing. People spend more because of rewards. They carry balances because of minimum payments. They pay interest because of optimism bias. The bank profits at every stage, and the cycle continues. The credit card isn't just a piece of plastic. It's a finely tuned money-making system. And once you understand how it works, you see the truth. The system isn't designed for your benefit. It's designed for theirs. The bigger picture. Credit cards are marketed as tools of freedom, convenience, and opportunity. And for a disciplined few, they can be exactly that: a way to build credit history, earn small rewards, or manage short-term cash flow. But for the majority, they represent something else: a silent trap, a system built on human psychology, where every design feature nudges you toward spending more, paying later, and sinking deeper. A system where your weaknesses are not accidents, they are the business model. The dark side of credit cards is not just about money, it's about control. The industry has mastered the art of making debt feel normal, even glamorous. And as long as that illusion holds, the profits will keep flowing. The question is not whether credit cards are good or bad. It's whether we as individuals are willing to see through the design and take back control. Because the truth is simple. The less dependent you are on credit cards, the less dependent you are on a system built to profit from your mistakes. In the end, credit cards are not the enemy. Ignorance is. The more you understand the psychology, the traps, and the business behind them, the harder it becomes to be exploited by them. So the next time you swipe, ask yourself, am I using this card or is it using me?